Derivatives. Derivatives in CFA Level 2 focuses on the valuation, pricing, and risk management applications of forward commitments and contingent claims. Candidates study forwards, futures, swaps, and options as financial instruments used to transfer, hedge, or speculate on market risks. The curriculum emphasizes arbitrage pricing principles and demonstrates how derivatives derive value from underlying assets such as equities, fixed income securities, currencies, and interest rates. Understanding derivatives is important because these instruments are widely used by institutional investors, corporations, and financial intermediaries to manage exposures and improve portfolio efficiency. Candidates develop the ability to evaluate derivative positions, assess pricing relationships, and interpret the effects of leverage and volatility on investment outcomes. These concepts support advanced investment analysis and strategic portfolio management. Pricing and valuation of forward commitments represent a major area of the curriculum. Candidates learn how equity forwards, futures contracts, fixed income forwards, currency swaps, and interest rate swaps are priced using no arbitrage relationships. The curriculum explains the carry arbitrage model and analyzes how financing costs, underlying cash flows, and interest rates affect derivative pricing. Candidates also study equity swaps and currency swaps to understand how cash flow exchanges are structured and valued. These concepts strengthen analytical understanding of how derivative markets maintain pricing consistency across financial instruments. Forward commitments are particularly important in portfolio management because they allow investors to hedge risk exposures, adjust portfolio duration, gain synthetic market exposure, and manage financing costs without directly trading the underlying assets. Contingent claims analysis introduces option valuation techniques used to estimate the value of contracts whose payoffs depend on future market outcomes. Candidates study the binomial option pricing model and learn how to calculate no arbitrage values for European and American options. The curriculum explains how options can be valued as present values of expected future payoffs under risk-neutral assumptions. Candidates also identify arbitrage opportunities involving options and analyze strategies designed to exploit pricing inconsistencies. Understanding contingent claims is essential because options are widely used for hedging downside risk, generating income, and constructing structured investment strategies. These concepts provide a quantitative foundation for evaluating derivative instruments and understanding the nonlinear risk characteristics associated with option-based investment positions. The Black-Scholes-Merton model is another key component of the derivatives curriculum and serves as a widely used framework for valuing European options. Candidates study the assumptions underlying the model, including constant volatility, frictionless markets, and continuous trading. The curriculum explains how the model values options on equities and currencies while introducing the Black model for futures options and interest rate derivatives. Candidates interpret the economic meaning of model inputs such as volatility, time to expiration, risk-free rates, and strike prices. Understanding these valuation models enables investment professionals to estimate fair values for derivative contracts and evaluate market expectations. These concepts are highly relevant in trading, risk management, and the pricing of structured financial products. Option Greeks and volatility analysis are emphasized because they help measure derivative risk exposures and guide hedging decisions. Candidates study delta, gamma, theta, vega, and rho to understand how option values respond to changes in underlying variables. The curriculum explains delta hedging strategies and examines how gamma risk affects portfolio sensitivity to market movements. Implied volatility is also analyzed as an important measure of market expectations and option pricing behavior. Understanding the Greeks is critical because derivative positions often contain nonlinear risks that cannot be evaluated using traditional measures alone. These concepts strengthen the ability to manage portfolio exposures dynamically and evaluate how changing market conditions influence derivative valuations and investment performance. Overall, derivatives in CFA Level 2 develops advanced quantitative and analytical skills necessary for pricing, valuing, and managing derivative instruments in global financial markets. The curriculum combines arbitrage theory, mathematical valuation models, hedging strategies, and risk measurement techniques into a comprehensive framework for derivative analysis. Candidates strengthen their understanding of how derivatives are used to manage market, interest rate, currency, and credit risk exposures across investment portfolios. The topic also reinforces the importance of volatility analysis, leverage management, and pricing consistency in modern financial markets. Strong mastery of derivatives concepts enables investment professionals to design more sophisticated investment strategies, improve risk management practices, and evaluate complex financial instruments with greater confidence and analytical precision.